Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at USA rare earth.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do it. This one is, well, it feels like it's less about a stock and more about a huge geopolitical project.
That's the perfect way to frame it. You can't just look at this through a normal valuation lens. It's really a story about strategic independence.
Right. USA Rare Earth is trying to do something incredibly difficult. They're going from just, resource developer
To a fully integrated supply chain. The first one, really, outside of China, that goes from the mine to the metal all the way to the finished magnet.
And that's not just a business plan, is it? I mean, that's basically a national security blueprint for the U.S.
It absolutely is. They are trying to solve a critical, urgent problem for the United States and, frankly, all of its allies.
So let's get specific, because the value's in the details here. They're not just digging up any old rare earths. They're focused on the heavy ones, the HREs.
Dysprosium and terbium.
Why are those the ones that matter so much?
Well, you can think of rare earths as like the essential vitamins for technology. The light ones are common. The heavy ones, they're the ones that give high-performance magnets their power, especially at high temperatures.
So things like guided missiles, fighter jets.
Exactly. The most advanced defense systems, the best electric vehicle motors. You simply can't build them without these specific elements. They're non-negotiable.
And the really scary part is that China controls, over 90% of that specific supply?
That's the number. And that's the strategic vulnerability that this whole company is built to fix. For the Department of Defense, that reliance on China is just not sustainable.
Okay, so to fix that, they're building this company on 3 distinct pillars. Let's walk through that.
Right. It's their competitive moat. So it all starts upstream at the source.
The Round Top deposit in West Texas.
Yep.
One of the richest known deposits in the U.S., not just for a whole suite of rare earths, but also other critical stuff like gallium and beryllium. So they have their own secure feedstock for decades to come.
But getting it out of the ground is one thing. The real challenge has always been the next step, right? The processing.
That is the Achilles heel for the entire Western world. We can mine the rock, but we lost the expertise to turn it into the high-value metals and alloys.
And that's where their midstream pillar comes in, the big acquisition.
The acquisition of less common metals, or LCM in the UK, this was a game changer for them.
So what did that deal really give them?
It gave them 3 decades of intellectual property. I mean, this is the institutional knowledge, the secret sauce that China has spent a generation perfecting. LCM is pretty much the only proven producer outside of China that can handle both light and heavy rare earth metals at scale.
So they didn't have to reinvent the wheel, they bought the wheel.
They bought the whole car. And that expertise flows directly into the final and most valuable piece of the puzzle, the downstream part, the magnet factory in Stillwater, Oklahoma.
Exactly. This is where they turn those alloys into the finished high-performance magnets. And the big date everyone is watching is Q1 2026. That's when they're targeting commercial production to start.
That's the moment the whole story pivots from a plan to actual revenue.
That's the inflection point.
Okay, that roadmap sounds incredibly compelling.
Yeah.
But let's get real about the financials, because building all of this at once has to be ridiculously expensive. This company isn't profitable.
Not even close. You have to go into this with eyes wide open. The company is deep in the red. We're talking a net loss over the last 12 months of about $107 million.
And that Q3 report was a bit of a shocker, right? The loss was way bigger than analysts were expecting.
It was a loss of 25 cents a share when the consensus was closer to 10 cents. But you have to understand why those losses are so big. It's not because their day-to-day operations are a mess.
It's the CapEx, the capital expenditure.
It's all CapEx. They are pouring money into building the mine, the processing facility, and the magnet factory. These are huge one-time costs to build assets that aren't making any money yet.
But if you look at just their sort of day-to-day operational burn, it's more manageable.
Much more. Once you strip out the big non-cash charges and just look at the cash they need to, keep the lights on and manage the projects, it's around $11.6 million a quarter. They're being disciplined where they can be.
So the big question then is runway. How long can they keep building before the cash runs out?
And this is the surprising part of the story. Despite those huge losses, their balance sheet is a fortress.
They're sitting on a ton of cash.
A ton. After some recent warrant exercises, they have a pro forma cash position of roughly $420 million.
Wow. Okay. For a company at this stage, that is a massive war chest.
It's huge, and it gives them a buffer. Management says it's enough to fund them comfortably through 2027, well past those key commissioning dates.
So this is that classic story of pain now for gain later.
It's the definition of it. It's an earnings trough. You spend the money now, you absorb the losses now to build high-margin assets that, once they're running, should deliver massive operating leverage. It requires patience.
Speaking of timing, what's that first big catalyst we should be watching for?
Q1 2026. Hands down, the start of commissioning at the Stillwater Magnet facility.
That's when the revenue starts to flow.
That's when this whole thing becomes real. The cash burn story starts to flip into a revenue story.
And the crazy part is, they already have customers lined up for years, don't they? The demand visibility is, well, it's incredible.
It's almost unheard of for a pre-revenue company. Management has said on the record that their magnet demand is basically locked in to 2033.
To 2033. That's a 9-year runway of contracted revenue before the factory is even fully up and running.
A 9-year runway. And they've also said they don't have enough capacity to meet the demand that's already there.
So they're already sold out. That says everything about how tight this market is.
It really does. It's why you're seeing these major partnerships form already. After they bought LCM, they immediately signed a binding deal with Arnold Magnetic Technologies.
And Arnold is a huge supplier to the U.S. defense and aerospace industry.
A massive one. So that deal immediately validates the quality of their product and locks in a key customer. Then they signed a deal with Solvay, another global leader. The commercial relevance is already proven.
And they're also trying to speed up the mining part, the Round Top project, to control their own costs even more.
Correct. They pulled that timeline forward by 2 whole years, now targeting late 2028. The faster they get their own low-cost feedstock, the higher their margins will be. It's all about that vertical integration.
Okay, now let's shift to the, let's call it the X factor, the highest risk but also highest reward part of this.
Yeah.
The geopolitical angle and potential government money.
This is what's driving a lot of the volatility in the stock right now. The market basically sees USA Rare Earth as the next logical candidate for a big government support package.
And this isn't just speculation. The CEO confirmed it, didn't he?
He did. Back in October, he said the company is in close communication with the White House. That statement was a bombshell.
Because there's a precedent for this. Another company in this space got a massive check from the government.
A huge word. A competitor got a $400 million investment package from the Department of Defense.
So if a deal like that came through for USA Rare Earth, it would. I mean, it would change everything.
It would instantly de-risk the entire business model. You'd get a massive capital injection, plus most likely guaranteed long-term contracts to buy their magnets. It's a binary event, and the anticipation of that announcement is a huge driver of the stock price.
And you can see that excitement in the stock chart. It's been all over the place.
Volatility is the name of the game here. The 52-week range is something like $5 to $44. That tells you it's a news-driven, emotional stock.
But the long-term trend is still up.
It is. It's holding well above its 200-day moving average, which is a key technical sign of a long-term uptrend.
So what about the price action since that White House news dropped?
The stock spiked hard, and then it's been consolidating, sort of moving sideways. Some analysts see this as a classic bull flag pattern.
Meaning it's taking a breath before the next move up.
That's the theory. It's building a base, waiting for the next catalyst, which would either be the Q1 commissioning news or that government funding announcement.
And are the big funds, the institutional investors, buying this story?
They seem to be. The data shows they've been steadily increasing their positions. So the smart money seems to be accumulating shares, looking past the current losses to that 2026 catalyst.
Okay, we've laid out a very strong bull case. We have to cover the other side. What are the biggest risks here? What keeps an investor up at night?
Execution risk. Number one with a bullet. They are trying to build and commission a mine, a specialized metals plant, and a high-tech magnet factory all at the same time.
3 gigantic, complex industrial projects.
It's incredibly ambitious. Any significant delay on that Stillwater facility, if Q1 2026 slips to, say, Q3 or Q4, investor confidence could get hit really hard.
And a delay means they're burning through that big cash pile faster than planned, which leads to the next risk.
Dilution, exactly. That $420 million is a lot, but if they have major cost overruns, which happens all the time in projects like these, they might have to go back to the market and raise more money by issuing new shares.
And we've also seen how sensitive the stock is to just the perception of geopolitics, right?
Oh, absolutely. The stock took a sharp dive recently just on rumors that U.S.-China trade tensions might be easing.
Which shows how much of that geopolitical premium is baked into the price. If that urgency in Washington, D.C. fades for any reason,
The stock could get hurt even if the long-term need for a domestic supply chain hasn't changed at all. You have to be ready for that kind of volatility. And the Q3 earnings miss is a good reminder that the near-term financials are just weak.
so to wrap it all up, this really is a high-risk, high-reward bet on the onshoring of this critical supply chain. And everything seems to pivot on what happens in the next, say, 3 to 6 months.
That's it. It comes down to two things. One, the successful commissioning of the Stillwater magnet facility in Q1 2026. And two, that big, speculative, but potentially game-changing government support deal.
Get those two things right, and the path forward looks very clear.
The upside is undeniable. A secure, high-margin business with demand locked in for nearly a decade. But the next few months are the real test. They have to prove they can navigate the immense operational complexity to actually meet that demand. So the core question you have to ask yourself is, does the strategic need for these materials outweigh the massive execution risk in getting there?
If you enjoyed this analysis, please remember to subscribe, like, and comment to support Smart Wealth with Joshua.